So here we are at a basic 14-day free trial account. For those of you that are just getting started, I do encourage you to take advantage of the 4 steps that are listed here. The quick start guide. You can go through the various flash tutorials, and on most tools you'll see a help video section there. You can join us for our live webinars during the week, or of course watch our archived webinars at any time. You can also access that under the free webinars and schedule a free coaching session also right there with the free coaching link, or you can just email in to schedule a session as well. All right, now we do have some questions that have already come in. Okay, let's see here. Oh, okay, Sam had commented to me this today. He was talking about some of his bottom feeding strategies. He was looking at a few stocks that he entered down at the bottom, and Sam says good afternoon, but he's having a guest at home and only be here for the first half. Well, I'm sorry to hear that, Sam, but I hope you get to enjoy some good information here as well. All right, here's a question that came in. It's from Jim. I'm sorry, it's from Jim. And Jim says, is there any way that I can see the chart of an option? Okay, an option chart, just like you might see on a stock chart, but for the option. And the answer is yes. Okay, so what I'm going to do is just go to a chain for a stock, and let's take TLRY. Tilray, of course, one of very volatile stocks. And I'm just going to the chain to take a look. Let's go out to, let's just say, December. Okay, now, what I'm looking at is a call and put chain, and just a small chain, so we're seeing various strikes. Tilray closed today at 110.58, and if I want to see the behavior of, let's say, the 110 call through history since the option was released on the market, I'll just use the more information button here. I want to go to research, and I'm going to go to call research. I could go to put research as well. We're just going to go to the call. Now the research tool gives you all the available information that we have for this particular option. Pretty much on the right-hand side, you might focus on the probability, current implied volatility number, the percent implied volatility range and total range, Black-Scholes value, and the Greeks as well. But down below, you see that we have a chart. And the basic chart default is showing you the option bid over time against the implied volatility. Now, it says here that we're only seeing a view from October 25th through 11/15. But that's not the entire date range. Using the little slider down at the bottom, I can just scroll backwards here, and I can see further dates back. What I typically want to do is just click on the far side. I'm going to click on the left side of this gray slider, open it up as much as I can, and now I can see the graph of the option bid, the change in bid price for the option, compared to the red line, which is our implied volatility. This is over the life of the option. Since this option was released, this December 110 call on Tilray, and naturally the 110 put, same series for December, was released on around September 5th. That's when it was first available. We first had the data coming in from the exchanges. Now I can shift between other views. Here, as I mentioned, we're looking at the option bid versus implied volatility. I could change that and look at the stock price versus implied volatility. Let's click Draw New Chart. And now I can see how the IV has changed with the fluctuations of the stock price over time. And you see some things that you'd expect. When the implied volatility gap, the stock went really high. And then there's some other ranges there with different gaps and different movements. But you see, you can scan against other things. We could look at the option last price, Black-Scholes value, volume bid compared to ask price, volume to ask, however you want to set the two up. So that is how you can view the graph of the option. It's just available for the history of that particular option, when it was released on the market, of course, to when it is trading now. I mentioned that because what we show here on power options, of course, is what's known as the percent implied volatility range. This shows us where the options, the specific option, implied volatility is now compared to where it has been over the life of the option. There are other services out there that do other types of IV percentile and IV rank, and they say that they base it off of a 1-year volatility. Well, this option didn't exist for 1 year. This option's only been available on the market since about early September. So it doesn't do me a lot of good to compare volatilities, what was going on in the stock, when this option didn't exist. That's our feeling, that's our sentiment, that is our approach. So in most of the searches, you can screen for positions by percent implied volatility range. But again, it's based over the life of the option in the range of this particular specific option, not based on an average of what options existed before this was even released on the market, or where the market conditions were vastly different 12 months ago from what they are today. How to use the percent implied volatility range? Well, in theory, naturally, if I'm selling a position, let's say I'm doing just a simple covered call, and you're one of those covered call traders who wants to get maximum return for the position, you want to look for higher implied volatility. Well, in addition to looking for an implied volatility of maybe greater than 30%, you probably want to sell something that's maybe above the 75% implied volatility range. That it's at the higher end, of its total IV range. More bang for the buck, in theory. The other theory is, of course, is that if the stock settles and the implied volatility number reverts back to the mean, it goes back to 50% or maybe drops a little lower, your premium will decrease and you can buy it back more cheaply. The reason why I mention that is because when thinking of a covered call strategy, it's a neutral to bullish position. And what do we know about options that have a higher implied volatility? Not that greater than 30% is extremely high in the market, but are in the higher percent of their implied volatility range. Well, that usually points to an event coming up sometime in the near future where your option will be affected on it, whether it's earnings, FDA approval, phase 1, phase 2, or possibly phase 3. News had come out recently about a pending patent lawsuit or something along those lines. That's when you get a higher percent implied volatility range and a higher implied volatility. Is it good to get more premium? Yes. Do you have to know what is causing that volatility to be increased? Absolutely. Because I don't want to enter into a covered call position. I haven't looked at Twilio before, but here's a simple covered call of buying the stock at 89, selling a deep in the money 80 call for around 1230, 1240 at midpoint for reasonable high return. But of course, this carries with it a risk. If the stock drops 20% and falls to, let's say, $71, $68 per share, we're taking on a large loss. There's something that's possibly coming up that could cause this stock to swing. Now, if it swings up, that's good for us, but if it swings down, we're taking that extra chance that we could suffer loss even with the high premium we're collecting and the high downside protection of a break even of about 13 points below our price of the stock. So it's a trade-off, right? The implied volatility is a trade-off. It's very useful to use. It's important to know. I use the implied volatility range when buying and when selling. But again, if it's a certain position that's not really protected, a covered call, cash secured, naked put, even if I'm deep in the money with the covered calls we just saw with Twilio or out of the money with the naked put, if it has an implied volatility that seems double of the stocks that are around it that have the same price, same expiration, and the premium is inflated to almost double, that is a warning sign. That tells me that something is coming up and I may want to do a different strategy if I still trade that stock, or move on to something else. So I don't want to enter a covered call or naked put if there's a chance that an event could cause the stock to swing down 15, 20, or 30%, which we've seen with some earnings recently. Did we see any today? Yep. PCG had a 37.8% gain. That'd be great for a covered call if you got a high premium, but if you had been on the opposite side and done a bear call credit spread, something along those lines, you'd be in a bad position. Doesn't look like anything fell by 30% today, but we did have some strong upward movements, likely due to earnings as well. And they would have had a high implied volatility and a high implied volatility range coming in today's trading for any November series any December series or beyond. So when you see something and you've heard it a dozen times before in any type of options discussion or education class, if something looks too good to be true, if you screen for a covered call position and all the 25-day out returns are around 2.5%, and there's one on your list that's 7% and one on your list that's 5%, something's going on with that stock, an event coming up before the expiration that's going to affect that expiration cycle, and you could see it move in your direction, but you could see it move drastically in the wrong direction and get into trouble. So when it stands out, there's a reason it's standing out, and that's going to be into the implied volatility. Comment comes in from Sam. It says, like NVIDIA, 15% drop and kept going lower, lost $32, excuse me. Yep, there it is. It's in there. It's a 19% drop, $38 down, as you mentioned, Sam. Why don't we take a look? Let's take NVIDIA as an example. And what I'm going to do is we're just going to look at the chain, and I'm going to look at the call chain for NVIDIA. I'm sorry, I'm just going to go here. We just want to look at the calls for right now. And I've got my basic column selected for IV and more. And do I have it over here? No. I'm going to add it real quick. All right, so I'm going to add a column. I'm going to add the percent implied volatility range and the actual range that's shown. I'm going to take a moment actually to reorder the columns because we're going to put these two new ones right next to the actual implied volatility for the option itself. Okay, now as Sam mentioned, we saw a 38% drop today, big fall. Let's go ahead and do that. Close the window. This is just going to pull our chain back up for us. Oh, I got to resend the information. My apologies. There we go. So there's my actual range, and here's the percent implied volatility range. Why did I do that? Well, I want to go back to yesterday. Look at where the IVs were. Now, we were looking at the 200 strike, the sort of at-the-money strike, 202.50 in this range here. The implied volatilities are all at 200%, 2.35, 2.34. All of the positions for today's expiration were in the 85, 90, 90th percentile. If I bought NVIDIA at 200 and sold the at-the-money call as a covered call, we would never do this right before earnings, of course, but if you saw the premium and said, wow, that's fantastic, that's a one-day trade with about a 4.4 potential return and a 5.3 downside protection. Meaning the stock can fall 5.3% for technically losing money on the position. This looks phenomenal for a one-day trade. Well, it's because it had earnings coming up. And then, of course, what happened today? Well, as we saw, it dropped about 40 points. Did the $11 hedge your position? Yes. Did you still take a 20-point loss, 25-point loss on the trade? Yes. Not where we want to be going forward. But, of course, we go to current, and the IVs essentially just all drop back down to normal, 20%, and so forth. Okay, they all drop down to average. Let's take a look at November 23rd because this was also affected. Here we are today with implied volatilities at 0.5. See our total range of 0.5 to 1.262, 263. And the implied volatility ranges are all down now below 50%. Some are at 0%. They're back at the bottom. But for that expiration, where were we yesterday before the event? We're all at what we'd expect, right? 89, 93, 94% implied volatility range, 0.95, 0.94, 0.92s, all at the upper end because this series was going to be affected by the earnings as well. We go to the current and they're all back down to the bottom line. That is also important to mention for those of you who trade selling strategies, covered calls, and more, is I have had customers mention to me that said, okay, well, I got into NVIDIA at 202 and, okay, well, 202.39. And I sold the 202.50 for a little bit above $11, which is 5.6%. I know earnings is coming up, Mike, and that's okay because even if the stock falls, if it falls down, you know, I've got $11 and more protection. So if it falls down to 185, 189, I'll just sell the next out of the money 1 week out or 2 weeks out for another $11. No, you won't. Because you sold when the implied volatility was here. Now the implied volatility is back to this 0.3, 0.4, 0.5 range. The volatility for these options is going to lower after the event, and your premium's not going to be worth $11 selling 1, 2, or 3 weeks out anymore. At the money, or even slightly out of the money, it's going to be $2, $3, a third to a fifth of the price you received with the inflated premium. So you have to take that into account. If your idea is the fact that you're selling into a high IV and you figure, well, even if the stock falls, I can continue to sell against it and get this premium. After the event, your implied volatility is going to collapse. You're not going to have that premium. Case in point, at the money option yesterday, 8 days out in time, was at $11. A little bit more than that, probably $11.20 at midpoint. We go to the current chain. This was close of yesterday, before the earnings event. We go to the current chain for our calls. Same expiration, November 23rd. The now at the money is $4. One strikeout is $3.05. Let's go 2 weeks out. Let's go to November 30, now that the event has passed. Okay, so about half, but I had to double the time in this case. I'm 14 days out instead of 7. All right, but that's still a reasonable return, 3 or 4%. But remember, as a covered call, if you paid $2.02 and collected 11, now the stock's down to 164. You sell this 165 call for $6. Hey, you've got more of a hedge. But now if the stock bounces back to 180, about halfway between where it fell to moving back to where it was, well, that was going to cost you $15 to $20 to buy to close this call. Otherwise, you get assigned for a loss of, say, 11, 12 points. That's always something you've got to keep in mind as well. All right, so that's just a review on where you can see the implied volatility graph and the graph for the option, why the implied volatility range, why the implied volatility range is important, and how you would use it, and what to expect if you sell into high IV and you have the crash afterwards. Okay, so that was discussion with NVIDIA. Yeah, Sam, I just saw that Goose closed above 70.15, 70.13 I think was the close. You said you had a straddle on Goose, not in NVIDIA. You should have done well with Goose. Yeah, it gapped up to about 70 right after the earnings on Wednesday. Okay. Sorry, I chuckled to myself. I just love the name this person used to sign up for the webinar. We're talking with Cash Pilot Captain right now. And CPC, the Cash Pilot Captain, wants to know, could you give an example of an SPY short-term calendar? Okay. How to find good candidates for calendars or diagonals? Okay, absolutely. On power options, as I mentioned, you can screen by 23 of the most commonly used option strategies. One I already have in there is calendar call. We also do have calendar puts, which you can add through the other strategies menu if you wanted to look at the calendar put spreads as well. Just go ahead and add that. Okay. So I don't do this personally. I'm going to show you how to use the tools to do exactly what you want, I'm pretty sure. I don't do this personally. I don't trade diagonals or condors on one specific security on a regular basis. I'm sort of a child of power options as far as options investing goes, and I typically am looking for new positions after expiration using the search rather than just keep adjusting one position on one security. I'm not saying that's a bad idea, don't get me wrong. I have investors that do condors and sometimes short strangles just on SPY or QQQ, and that's all they want to see. Okay, but for calendar calls, if I wanted to set up a search to just look for diagonals on SPY that match my criteria, whether it's a horizontal, true calendar, I don't like using that term, but a horizontal or a diagonal, you can do both with the search. It looks at both horizontals and diagonals, where the diagonal is sort of a version of a poor man's covered call. You're buying an in-the-money call, lower than the current stock price, and you're selling at or out of the money against it. All right, so let's go into search. Now, as with any search on power options, when you first open the search and you see the listed trades, you're probably looking at one of our default criteria. I myself usually use the initial value screen as my starting point, and I make subtle changes to some of the criteria below based on my requirements. So I might adjust the net debit here to only look for debits less than 10, and I might even restrict the range out of the money for the short call to be no more than 4 or 5%, while still looking 5% in the money, and I might increase the option bid. Okay, I'm just reviewing this as a basic structure. Now, I just run that search there. That'll help me narrow it down a little bit. And I'll always avoid earnings between now and expiration. Okay, so here the first one that comes up is AstraZeneca. Before I look at anything else, before I look at what I am using for stock criteria, technicals, or fundamentals, my question is this a good spread? Okay, so I'll just go to the profit and loss chart. And what we're looking at here is a stock trading at 40.67, selling a December 42 call out of the money for 65 cents, and buying a 2020 far out call for 7.05. Best case scenario, the stock's trading right at 42 based on the Black-Scholes pricing model. I'll get 36.6%. I collected about a 9% premium, almost 10% against the price. You can set that as well based on how much premium you want to set. That's important for your right cycles. And that's important. I'm going to get to that in a moment. Okay. So would I consider this a good calendar? Yes. If now I looked at the stock chart and I had the sentiment that over the next 3 to 4 months, AstraZeneca was in a good bullish pattern. It has had a MACD crossover recently and been moving up, but it has started to show some weakness, pulled back, and is going back down. Might be a concern for me going forward for a longer-term neutral to bull trade. Cash Pilot Captain, CPC, is not interested in that. I just wanted to review what criteria I might quickly change to narrow down the list based on what I'd want to see. If you want to look for a calendar, diagonal or horizontal for SPY, short term, what you'd want to do in the search is simply clear filters. That takes everything out. What do you define as a short term? Okay, I'm going to show you what I might look for, but ask yourself, what do you define as a short term? Naturally, let's just think next week. So I'm going to select all expirations, and I'm going to put my near days to expiration of, let's say, 1 to 9. Okay, so next week's expiration. Rajiv, I believe, he's here usually on the webinars, and he sometimes does calendars and asks me questions about he sold one that was out of the money and bought one that was 2 weeks out, either same strike or a different strike. That's really short term. In the webinar that I'll show you in a moment, where I discuss my calendar spread criteria, my feeling is that if you're going to do a short term where you want to sell weekly, to me, it usually makes sense to have at least 4 right cycles. Maybe 3 to 4 right cycles if you want to go to judgment. What do I mean? Is that if this is 7 days out, 8 days out in time, next expiration, I want the long to be probably at least 30 days out in time. So I can write every week against it for 4 cycles if necessary, if the trade does not do what I want. I can have that extra hedge for 3 to 4 right cycles against it. So I'm not typically selling 1 week out and buying 2 weeks out with this strategy. It's more along the lines of 3 to 4 weeks out or further. I typically like to sell 14 days out and buy 3 months out, personal preference. But you can set it up any way you want. So I'm going to do mine. I'm going to set this up to go between 30 and 40 days to expiration. Now, if I'm doing a diagonal, I'm planning on buying an option 3 to 4 weeks out in time, selling near term against it, but I'm buying a call that's slightly in the money. I still probably want a net debit of, let's say, less than $5 or $6. So this is a net credit. We've got to reverse it. I'm going to look for a net credit of greater than negative, let's just put in 550. Let's allow us some room. Okay. Downside protection, what is this? Now, this is for a covered call. You may realize that. If you do a covered call, you buy a stock and you sell a call, premium you generate divided by the stock price is referred to as downside protection. It's how far the stock can fall before you're technically losing money on the position. In this sense, it is related to the long option, not the short. Okay? I'm sorry, not the stock. So it's the option premium we're selling divided by the option we're buying. I'm going to want that to be at least maybe around 10%. Max return, that peak return I just showed you on the profit and loss chart, even though that was an extended one, I'm going to look for about 5%. If I'm doing a diagonal, I want to be slightly out of the money with my near-term call. I want to be at or slightly out of the money, probably no more than 3-4%. By the way, I don't really have to cap the upside for the range out of the money in this case on this diagonal, because forcing it to be a 10% downside protection is going to take care of that for me. I couldn't find something that was 20% out of the money because that wouldn't give me 10% against the option I'm lightly buying. Okay? And at the same time, I want the long call to be in the money maybe by about 3 or 4%, and I could restrict it to maybe 5% to lower the cost. Maybe let's go 2 to 5, okay? Slightly in the money, but not too deep in the money because then the cost would be too high and I wouldn't get that 10% anyway. This is going to be pretty close. One other important factor for criteria I always discuss is the debit strike difference ratio. What is this? This is the net debit that you're paying into the calendar divided by the strike differences. I want this to be less than 1 when I'm doing a diagonal. Why? Because if SPY suddenly shoots up beyond my short call and I get assigned early and the broker exercises my long to deliver the short, if my net debit was higher than the difference in strike prices, I will be at a loss. The return we see here on power options is based on the Black-Scholes pricing model of where the long call price will remain at short option expiration. I'll illustrate that for you in a moment. Now, I'm not really going to worry about delta ratio here. I would be worried about delta ratio and use a filter if I was buying a 4, 5, or 6 month out option and selling a 1, 2, or 3 week out against it. It's a longer term play. I'd want a delta ratio of probably greater than 1.8, meaning that the long option delta is 1.8% higher than the short, or 0.8% higher as a ratio than the short. So for every dollar the stock moves up, I'm gaining more on the long than I'm losing on the short. But this is a different play. The shorter term trade, I'm not really worried about that because I've got to I can't go as deep in the money and still maybe have a reasonable return. If I did want to go deeper in the money, guess what I got to do? I got to increase this net debit. I'm not saying it's a bad idea to go deeper in the money for just 3 to 4 weeks out, but I have to increase that net debit. All right, that's just the option criteria. Now what I want to do here is go to fundamentals. Rather than put in anything in, we're just going to say SPY. We are going to get other multiples here, okay? And the reason why is because we know SPY now has Monday and Monday and Wednesday expiration cycles. Okay, I was afraid of this. It's not an issue. No stock options match my criteria. Guarantee you my debit is too low. Let's take this up to 15. The return should still be good. I'm just going to take that out just in case. Let's try to run that. Okay, I've got 1. And it's not bad. It's not bad at all. But in order to get that 10% against the ask, you see I'm paying $15.60 for about a $12 in the money option here, the 261 with SPY at 273.73. That's good. Downside protection 11%. I'm getting 173. Why am I not seeing a 277, something further out of the money? Because it doesn't have that 10% downside. I think this is too restrictive. I'm going to open it up. I'm going to lower my downside to 5%. Okay? All right, so still just the 1. Wow. Okay, that's what it is. Now, is this the best one that's out there? I'm not going to say that because I don't have a crystal ball either. I don't know if this is the best spread that's going to work because I don't know where SPY is going to be trading. In this case, I want it to be right at 275 in 7 days. If I think it's going to be at 280, regardless of what the structure shows, I'm probably selling at 280 and maybe buying at 270. But that's not going to match the structure I was looking for. Okay? And I'm not saying it has to, but you have to develop a trading plan. Is this a bad diagonal spread for SPY? I don't really think so. It's got a break even of 271, and if it falls to 271, I can buy this back more cheaply, or 275. I can roll it down to a lower strike one further week out in time and lower my cost basis further. As with any diagonal spread, it does take a 100% risk of what you invest in the position. If we have another October and in 7 days we see SPY down to 260, well, guess what? You're probably going to be at about a 70-80% loss. It's just the nature of leverage trading. Is a horizontal spread better? It's not so much that it's better, it's that it's different. This is a diagonal. I've bought a 260, 261 call. I'm selling a 275 to give me some upside room. I do have potential for an 18% return on the position if the stock's trading right at 275 next Friday on the 23rd. At 1 o'clock, remember, because the markets close early. Not going to be open till 4 next week. But let me swap this out. Let me take our 21st December 261 out. Let me lower the cost. Yeah, see how there's one every 2 days now? That adds to the complication. So let's do the December 21 again, but I'm going to do the same strike, horizontal / calendar. We're looking at the 175, 275. My apologies. Thank you. There you go. 275 put and the 275 call. This is our horizontal. It's about half the price. It's about $6. So naturally, this must be a better trade. Oh, did I not clear out the other one? I apologize. Give me 1 second here. That's not giving me the right chart. It should be a tent profit and loss chart. I'm not sure why I'm seeing this weird graph here. That is very, very strange, isn't it? I'm going to clear it out and enter again. I apologize. I'm going to try to refresh the page here. What we should be seeing, and I'll draw it. So here's our November 23rd. We'll sell a 275 call. I bought the 275 put, didn't I? I'm sorry. I am so sorry, folks. That was 100% me. Right strike, wrong series. Let's go to 275 now. My apologies. Much better. Still half. It's only at 513. Yay, there's our horizontal spread now. What is the issue? Well, remember the break even on the first one. It was at 271, I believe. So this one gives us a better lower break even because the lower cost of the 275 strike. But we also have an upper break even. The horizontal will always give you 2 ways to lose. Yes, you can manage the short option as the stock fluctuates up or down, just like you can with the diagonal. But if it runs from us, and I'm not saying it's going to gap up 7 points on Monday, but if it does and it hits up to 280, 285 by Tuesday, we're in the loss range. You've got to start to manage this, and at that point, what are you looking at? You're looking at a call you received 175 for that's going to cost you another $5 or $6 to move. You can get maybe another $1.75 back, but now you're going to increase the cost basis into the position. What is a good horizontal calendar? Well, it's one that gives you the premium that you want, gives you the return that you want, and that you have the expectation that this stock, this underlying security, is not going to move more than 4 points down or 5.5, 6 points up in price. If you think it's neutral, if you think next week it's going to be neutral with all the things that are going on in the market, what we call headline market trading, where any new headline that comes out can cause the markets to get a little jittery and go in one direction or the other, to the tune of 2, 3, or 4%, which in this case, think about it, 2%, you're talking about 4 points, essentially. 277 up, kind of close. 4 points down, you're at lower break even. Okay? That's a little bit tricky. This is extremely neutral. Yes, you have 3 to 4 right cycles. You have multiple right cycles if you use the 2-day out series. I don't try to use those personally for SPY. I just try to really focus on the Friday to Friday because, hey, I don't want to start messing around with other things. I do have an investor that does these type of trades with Monday and Wednesday series. I think he opens 3 to 4 spreads every week. So he opened positions for Monday expiration today. Near the close of Monday, he'll close or roll those SPY positions to the Wednesday series. Come Wednesday, he'll close or roll those positions to the Friday series. I think he's doing well. Ish. He's learning as he's going, but that's not something I do. But this is your standard horizontal. What do you look for? Well, up front, you'd probably look for at least 1/5, generating 1/5 the premium of the cost, okay? That's the return factor. We've got a good return factor here based on the total cost and the max profit. That's really good. Because this would leave you with 4 right cycles. If you did every week, this would leave you with 4 right cycles. So just collecting this 175, if it stayed with the same implied volatility, would more than pay for that option as you hit to December 21st expiration. And at the last cycle, you'd have a bull call debit spread. You'd probably have to use a 276 or 277 strike. You'd end up with a bull call debit spread as opposed to the calendar, or you would have closed it if profit had been met as well. Okay? All right. So that's how you can use the tools to find them. And to answer your question, what is a good one? This is a good diagonal spread in my mind. This is a good horizontal spread in my mind. If and only if you think this is a reasonable break even based on your expectation of the stock in the next 7 days. This is a graph that I would want. I know I'm going to have an upper and lower break even. Why am I more fond of the diagonals? Because it allows me to choose a direction. It is more capital intensive, but I'm risking 100% on both regardless. But it doesn't enter into that second loss if the stock really gaps up in price. Don't get as much premium ratio up front. Higher cost basis, that is true. I'm a couple strikes in the money here. A 265 might even look pretty good for the lower cost there. Why didn't it come up on my search? I bet you I know the reason. Let's say I did that December 21, 265. In my mind, looking at the views, that would be a reasonable diagonal spread with a stock trading around 272. Couple strikes in the money at the 265, 12.15 cost basis at midpoint, right? So we're going to buy the 265 to 275. Why did I not see this in my results? Look at the debit. It's 1041.50, roughly 1042, let's call it that way, okay? Leverage return, not as high naturally because of the higher cost. Another advantage here is if the stock falls, let's say, to 270, my long call is still in the money, so I can sell a 271 or 272 call against it to continue to hedge the position. On the same strike spread, the horizontal at 275 and 275, if the stock fell to 271, sure, my 275 expires. I have a much lower cost basis now, that 341 that we saw. But if I sell a 271 now, or a 272 against the 275 call I bought in the initial horizontal, you've now created a bearish spread where you're going to lose more money if the stock moves up because your short call is lower than the long. With this spread, even if the stock falls near break even, I can still sell the 270 and keep the same neutral to bullish structure that I wanted initially. If your sentiment reverses, sure, there's nothing wrong with converting it into something that would look more like a bearish spread in that scenario. But again, that's not typically what I like to do. And remember, if you manage a diagonal as the stock fluctuates up and down, and the stock, let's say, goes to 250, I should say ETF, I apologize, but the ETF goes to 250 and you say, let me sell a 255 call. Remember now you're in a different structure. Your broker is going to require you to cover the $10 of margin requirement for this cycle of the trade because your obligation is 10 points lower than your right to buy it. So that's a trick, a trap some investors might fall into as they try to roll down with the short option and go below their long strike. Whether you started off as a horizontal or even if you started off as a diagonal, you now create a bearish position, but if your sentiments change, that's okay. But your broker may require you to have that margin if your new short call for rolling is below the long call strike price. To me, this is also a reasonable diagonal spread, but it didn't match my criteria because the net debit was higher than the difference in strike prices. So if the ETF does gap up to that 280, unlikely, I know, but let's say it gaps up to 280 or 282 on Monday and someone assigns this 275 early, my broker says, well, I'm going to exercise the long to deliver the short. They buy at 265, sell them at 275. I get 10 points back, but I'm at a loss. Well, if that's the case, how can this be at a gain? Because this profit of 234 is based on what the long option will be worth if the stock's trading right at the short-term strike price. It's using the Black-Scholes pricing model. So if I take this to 275 at expiration, keep the volatilities about the same in this case, I paid $12.16 for the call, moves up a couple points, estimated value is $12.76, I gain 60 cents. And I get the full 175. There's my profit of the 235 for the trade. This works if and only if I can sell to close the long and take advantage of that time value that still remains. If it's exercised, I just get 10 points back. This 276 remaining of time premium is null and void if that is exercised. So to keep myself from the trap of a sudden gap up in price and risking having to exercise to deliver my short obligation by my broker and only getting the difference in strike prices back, I only look for diagonal spreads where the strike price, the net debit, is less than the difference in strike prices. And that's why we didn't see a lot of results on our SPY search. Let me take that out for you. We'll go back to our main screen. We just looked against SPY. Go ahead and click submit. There's a ton of them now. All these ones, the 70 results that match that other basic diagonal criteria I was looking for. They have the downside protection I want. They have the lower net debit that I'm looking for. They have the return that I want. Only one of them that came up in the initial search has a net debit less than the difference in strike prices in that case. And so I would be wary of any of these where it's not, for any sudden movements one direction or the other. And remember, in both strategies, what are we looking at? Sam had mentioned this, but in both strategies, whether I'm a diagonal or horizontal, what am I looking at? You want something that's not going to move that much. Whether I'm in this diagonal or I did the horizontal, my estimation for the next 7 days, my expectation, is likely going to be that I don't think SPY is going to move more than plus or minus 1% beyond my short option strike price by next Friday. It is a neutral position. You have to be neutral in the market. Yeah, Sam adds some feedback in the relation to that. He says he feels that anyone who wants to try to do the horizontals and hasn't been practicing them, you may want to paper trade them for 5 to 6 months just to see how they perform, because these things can snap on you quickly. And remember, you can lose in both directions, and over management can also get you into trouble. Another thing he mentioned supporting me as to why I don't trade the, Sam has mentioned that he's been doing these for a while, meaning the Friday series, Wednesday series, and Monday series. And he says a lot of times you have to end up buying back. So if on Monday you sell the Wednesday series, or you roll on Monday to the Wednesday series, in the first couple hours of Tuesday, you find yourself rolling that Wednesday to the Friday anyway. You have to watch it much more closely and much more carefully and continuously manage the position. That's kind of a headache for me. You know, I don't have a lot of time in the day to do that based on the other things I'm doing. Now, what Sam does do, though, in relation to that, he also mentions that he buys 2 to 3 month out options on SPY, and Sam enjoys doing it. He just said that, haha, I enjoy doing it. Sam's discussion is he'll buy an option that's 2 to 3 months out in time on SPY. He tells me he's got the January 270 right now, and he will sell the Monday and then roll it to the Wednesday and then to the Friday against it continuously to get the most race cycles. And that makes a lot of sense. That is the strategy. Is you also want to maximize the right cycles to continue to cut down the cost of your long option and put you in a better position as time goes on. But it needs much more management. You need to watch it much more frequently if you try to do those Monday, Wednesday, and Friday series continuously during the week. I mentioned I don't have the time because most of the time during the day I'm handling coaching sessions, emails, customer phone calls, yes, watching my own trades, also preparing webinars and doing other things. I cannot watch my screens as actively as Sam does or other investors. And that's why I cater my trading to what I have the time for to do during the day, as opposed to just going full time with the trading. Okay? So, all that being said, Sam also comments he owns the 211 SPY call from a year ago as well. That must be very nice right now. All that being said, so for Cash Pilot Captain, at any time you can go to the free webinars page. You can access it right there under the main view, but it's also a public page, so you can go to the website at any time. The link here is powerup.com/webinars.asp. I just sent it to everyone in the link. Under the Options Strategies tab, you see certain things as 8 ways to manage your bull put spreads, how to be successful with spread trades, calendar spread criteria, and calendar spread basics. Although we just spent the last 25, 30 minutes or so reviewing what I would look for in a diagonal, what I would like to see, what I would consider in a horizontal, although I will be honest, I don't trade them, but that structure, I know I'm going to be pretty much right at the money, and I still want likely 3 to 4 right cycles, if not more. And even if I'm selling weeklies, I still probably want to be 4 to 5 weeks out in time. Okay? But I'll look for that other criteria as well. But here, we discussed the calendar spread basics, defining horizontal versus diagonals, proper structure, what to look out for, what to avoid, goals and expectations. And then the calendar spread criteria, we talk about looking for stocks as opposed to one single, but the criteria I would use discussed in here for diagonal and horizontals would apply to even if I was just looking one stock at a time as opposed to whether I was looking across the universe to find diagonal spreads that match my criteria for what I use in my portfolio. I'm not saying you can't be successful with horizontals. I just don't trade them personally. One of the main reasons why we saw almost way more than double the return, right? We were looking at, the first spread we found was a 36% return here. Oh, that was on AstraZeneca. We didn't like the chart for this strategy, but we were looking at SPY. That first 275, 261 spread offered about an 18% return, I believe. We changed it to the 275 to 265 for December, and we saw a 20% return. But the 275 horizontal November 23rd to December 21st spread was a 57% return if the stock was trading right at 275 at expiration. And that is kind of the key. So here again is just another spread using a 268 call with a 275, 27% return, half the return we saw with the horizontal. Only one break even to the downside at 271.64. It pulls back from the max return as it goes deeper up. I'll explain that in a moment. But it never hits secondary break even. Okay? Why does this occur? Why is this the max profit at the 275 strike price for this spread? Why do I lose money if the stock continues to go up? Okay? Because remember, this is based on what the theoretical value of our 268 call would be if the stock was trading at 275 at the near-term expiration. It's using the pricing models to evaluate that. Okay. What happens, and I'm bringing this up because I mentioned I like to use a delta ratio of 1.6 when I enter the spread. That's the delta of our long divided by the delta of the short. And a lot of times I'm looking for a 1.8 ratio or higher. So what I'm looking for is that if the stock moves up 1 point, I'm gaining more on the long than I'm losing on the short. Short's increasing, but I sold it, so it's a negative to me as it increases in value. So the peak is here at 275 when our short call expires worthless, and we have a large gain in our 268, another 2-point gain. Not really, because of the delta is not at 1. Why do we give return back? Because the magic of what happens at expiration, even though I look for a delta ratio of 1.6, I know that when I get into the last 2 to 3 days to expiration, 1 to 2 days really, the delta of my short has one place to go. It can go to 0 or it can go to 1. The stock's, if the stock's above 275 next Friday, let's say it's at 277, my delta's at 1. That's worth 2 points of intrinsic value dead on with a delta of 1, my 275. What's the 268? Well, it's still holding a delta of maybe 0.79, 0.75. It's not at 1. It hasn't gotten to 1 yet. So at that point on the last day, any movement above the short call, I'm losing more on the short call than I'm gaining on my long, and that's why it moves back. And it's really bad with these, that ratio shift at expiration is really bad with the horizontal, because I sold the 275, bought the 275, it's at 277. My long delta is probably only at 0.6. My short delta is 1, losing 1 to 1 for any further gain there. Okay. All right. I was just looking at another question there. So that's the magic at expiration with these two strategies that you have to watch out for, is to remember that whether you're using calendar calls, calendar puts, diagonals, or horizontal, when you hit short-term expiration, the option that you sold is going to a delta of 0, which is normally good unless it fell 20% and you're at a huge loss, or the delta of 1. And that initial delta ratio you had is thrown out of the window briefly, because any further gain on that last day that moves up, you start to peel away from the max return because you're in a reverse delta. Delta of your short is hurting you more than you're gaining on the delta of your long. All right. Now, Paul asked a simple, good question, but easy to answer. What about selling cash secured puts at the money 3 months out? Could you use power options with that strategy? Absolutely. Other than our diagonal and horizontal discussion, naked puts, it's a cash secured put. Naked puts is a cash secured put. Naked puts is, of course, one of the 23 strategies. I didn't have it added, so let me take out our calendar puts, and I'm going to add in naked put. Okay. When you saw me pull up the initial search for calendars, it came up with a default that was a little bit more conservative, of buying an in-the-money call that's 8, 9, 10 months out in time and selling 1 to 2 months against it. Okay? You can customize that based on what expiration time frame you want. On a naked put, we do have a default criteria that Ernie tested for monthly picks of the day, naked puts with a monthly expiration, and weekly picks of the day. But just as we saw with the calendars, if I go into search, I see the results that match one of our default criteria, and I have other saved searches that we did during our webinars, Paul. But you can customize this any way you want to. How would I look for a cash secured naked put at the money 3 months out in time? All right, what I would do, scroll down below, and just as we did in the diagonals, I'm going to hit clear filters up here. Takes out everything. Now I can go straight to February, 92 days out in time. That makes it real simple. Or we could do what we did before. I could say all expirations 85 to 95 or 80 to 100. Okay, but in this case, we're just going to select the February series 92 days out. What do you want your yield to be? The naked yield is based on a cash secured amount. The option premium you're receiving, Paul, divided by the put strike price. 3 months out, I figure an average return for me is around 1 to 1.5% for a good out-of-the-money naked put, maybe closer to 1.5% for an at-the-money. I'm going 3 months out. Maybe I want a minimum 4.5% return. Unlike a covered call, I don't really have a downside protection. We call it the percent to break even. How far the stock could fall before you hit your break even price. Based on whether you're aggressive or conservative, you might want this to be as high as maybe 7% with an at-the-money 3 months out. Maybe 10% you could get away with as well. We're going to test it together. At-the-money range. I want to isolate it to be just at the money. So I can screen by percent in the money, which I wouldn't do with a naked put, or percent out of the money, or by number of strikes. So I could just go no more than 1% in, blank to 1, and no more than 1% out. If you prefer it a little bit more safety, you want it to be at to slightly out of the money, just put in 0% out of the money to 1. Okay. Do you have a minimum option bid price? $1, $1.50, $2, plug that in to the option bid price field. Even though it's 3 months out, you might not need to worry about option volume today. You might not see a lot of activity with a 3 month out option. You should at least look for some open interest, okay, and maybe some previous volume as well. All right, that's pretty basic. Got our expiration time frame, your requirements for yield for the 3 month, Paul, what percent to break even you look for, isolating it to be just out or at the money, 0 to 1%, very restrictive. Not per se to you, I'm just saying that that's what you wanted. That's at the money, maybe slightly out of the money. $1 minimum bid price. If yours is different, plug that in as well. What would I look for now? Well, I'm in a naked, I'm in a naked put, right? So if you just wanted to screen against stocks that are in a certain list, or you want to create a list, you can do that. I'd probably want to look for something that has at least a good earnings per share growth of 5%. Companies change in earnings from last year to this year because covered calls, naked puts are neutral to bullish strategy. I want to look for stocks that have maybe a good earnings per share growth, relative PE perhaps, whatever your range is there. I use 0 to 70, sometimes 0 to 50. Okay. Market cap. I might not want to look at small cap stocks. I might just want to look at mid cap or beyond. This is measured in millions. You can see it here. So I probably want to use something greater than 2,000 to just look for mid to large cap stocks. Do you want to avoid earnings between now and expiration, or you don't care because you're 3 months out? That's up to you. I'm going to try to avoid earnings between, well, no, I'm not. If you're going 3 months out, even if you already crossed earnings, you're probably crossed earnings again, or you haven't. That might be too restrictive with going 3 months out in time. You're likely to cross multiple expirations, meaning you're going to have very few results if you do that. But it's there if you want to use it. We'll use that in a second too. Oh, other fundamentals. I don't know your account, Paul. I don't need to know. But I know that if you're doing a cash secured put, that means based on the number of contracts you usually like to trade, you probably have some restriction of what you use for stock price. You're not necessarily going to trade 10 naked puts on Priceline and put up the full cash basis to do that. You might trade one, might trade none. Okay, so based on that, I might look for stocks, let's say between 10 and let's just say maybe 300. Yours might be lower. Mine is definitely low, by the way. My real one for my married puts that I use in my collars, I'm looking from about $10 to about $95 or so because I, planning on trading maybe 200, 300 shares. Anything beyond that is representing too much of my portfolio, and I like to keep open at least maybe 5 or 6 positions on my long stock portfolio portion. Anyway, everyone's a little bit different. Technicals, hey, I may want to see something in an uptrend. I know this seems like a lot, but in a moment I'm going to show you that it's really not that much at all. I'm going to use stock price above SMA 20. You can use Bollinger Bands, historical volatility. Average stock volume is a good one. That's measured in thousands. So I only want to see stocks that average 750,000 shares traded per day on average. You can also use RSI or MACD cross to look for more of a trend. But we're just going to keep this as is. We're going to keep it right where we've got it. 7 results. What's the main thing that's restricting this? Well, it might be the premium. Doubt it. Might be the yield. I doubt it. Might be the downside protection. Possible. I could open it up more by tweaking these filters very easily. It could be this. If I allow it to go 3% out of the money or more, take it up to, we double it. We take it up to 14. That's reasonable. 29.25, 29 put. 28.36, 28. These are all there. What's the deepest one out of the money? Oh, this one. 154 on Alibaba, selling the February 150 for 950, 6.5% yield for 3 months. Okay. If you want to go deeper out of the money, you want more protection. You had said out of the money, so that's the search I created. If you want to go deeper out of the money, just put it in there. You want more protection. You want to be 2, 3, 4% out of the money as a minimum. That's fine. Just tweak it. But then you're going to have to tweak some of this too, aren't you? You're going to have to lower your yield expectation and lower your return expectations. You said at the money, so I'm keeping it at the money for you. 0-2 takes us to 11. Okay. As I mentioned, though, I could open it up more if I just did a 4% yield and let's say a 5% to break even. That's going to open it up more. Just turning little knobs here. That triples it, takes it up to 36 results. Maybe that's too much. Maybe I want to go back to 4.5. So that's how you're starting. This is how you would start, and then you can tweak it from here. Your important factors of this range out of the money, 0 to 2%. Put in your desired expiration, your requirement for yield, percent to break even. You don't need to worry about that, but you can put it in. I'd look for some open interest, minimum option bid price, and then, of course, I would put in some technical indicators and more. Of course, Sam mentioned about the stops there. You could put it in 50. You could put it a 50% stop or so against the premium, so that if you do lose, you could only lose that. I typically don't do it that way as well. And Sam had the same problem with naked puts that I had with covered calls. Sam just mentions that he lost a fortune at one point doing the naked puts because, well, if you had done this strategy, I know you wouldn't have, but if you had done this strategy and oh, let's do it. I'm sorry. I'm talking to myself here. I'm going to take this back to where we were, Paul. I'm sorry jumping around a little bit. I'm going to go back to that 7 there, and I'm going to go back to that 11, 12 results here. Good. I'm going to save this search. I'm not saying this is a bad search, Paul, but what Sam had said is that he lost a ton of money doing naked puts at one time. It's the kissing cousin, lack of a better term, of covered calls. And in the money covered call has the same risk-reward profile as doing the same strike out of the money naked put on the same stock. Very, very similar. I stopped doing covered calls 12, 13 years ago after a year and a half, 18 months roughly of trading them because I wasn't getting ahead and I saw the flaw. I only do standard collars now instead of covered calls to keep the controlled risk because every now and then you do hit that one that just falls 20%, not related to earnings, not related to an event you could have seen on the chart or in the news, unexpected event, 20% drop. Well, yeah, you're going 3 months out, so you may be collecting 4, 5, or 6%. That's still a 14% decline. What did it do? If you got put early or your broker closed you out of that position, you've just wiped out 3 previous trades. It's 3 to 1. It can be worse, and that's what happened to me with covered calls, and I decided I was break even after 18 months, and there's better ways. That's when I started to do collars, so when I'm doing cash secured or buying stocks, I don't do covered calls or cash secured naked puts. I look at standard collars and married put positions for longer term growth with doing some spreads with smaller portions of my portfolio to control the risk. Long story short, this looks good. I didn't put in any technicals directly for MACD, Bollinger Bands, things of that nature. But let me save this. We're just going to call it 3 month out naked put. All right. And I'm cherry picking, and I apologize for that, but I want to show you what's possible. What am I going to do now? Now that I've saved this 3 month out naked put, I'm going to go to back test. I'm going to go Smart History Excel. I'm going to go to October 1st, and we're going to run our 3 month out naked put screen on October 1st. All right. Wow, much more. So there was 25 total results that would have matched this same criteria, Paul, we just created on October 1st. Oh, iRobot, 12% naked yield. Petro Basolia, 11. Avis 9.3. Man, that looks good. It's a good stock. Avis, Foot Locker, look at these stocks. We know most of these. Newfield, Dave & Buster's, not saying they're the best stocks, but we know them. They're known stocks based on that. You're looking for mid to large cap stock and some of that other criteria. We all know what happened in October. Where would we be right now? Because all of these were out to January, 109 days out, right? Closest to that next expiration cycle. So I'm going to calculate group results. This is the power of the back testing. I took a search we just created. I picked the worst possible month we've seen in probably 18 to 19, 20-month cycles. And when I hit calculate group results, it shows me where each one is right now. This is actually not as bad as I thought, although that's, oh, yeah, there they are. 33% on NFX, Newfield Mining, right? Newfield Exploration, down 20% on Parsley Energy, 10%, 11% on Lululemon, 24% on Yelp. Hey, we're 9% on PBR. That moved up good. But the other ones aren't near full profit yet. That's the closest one. Okay, so down here we can see just after the first month, we're 6 out of 15, 40% profitability, not bad. An average return of 6.4%, where SPX was down 6.9 and the Qs were down 11. I'm just using this as an illustration, okay? We could say that these positions, some of these positions are easy to manage. 3.6% loss, even iRobot, currently at 92.85. And we had sold the 110 when the stock was at 110.92. We got 12. I could buy it back now for 20, a 7.6% loss. I could roll down to maybe the 90 for another 3 months out and maybe get another $10, and we'd be close to break even. That's good. This one, I'm not going to say it's a lost cause, but it's probably going to take you 5 to 6 cycles of selling 3 months out. So we're talking 15 to 18 months out to make that back. Getting in 390, it's now at a loss of 15, a loss of about 12. Okay, this one here is huge. You took in 210 on NFX. You would have managed before then, I understand, but I'm just using this as an example. And if I did the same search in September, we'd still be in a similar situation because we would have had to cross through October before today's expiration, right? Let's do that. Let's do that one too. And I'm not trying to push down your idea. I'm not trying to push down your search. What I showed you, I think, is a reasonable search for what you want to do. I'm just highlighting some of the risks. Okay, so September 1st. Oh, I'm sorry, since this is my webinar account, I can only go back 3 months total, so I can only go back to September. This will pull up December series for our 3 month out. Yep, only had 7. iRobot's still in there. Lululemon's still in there. Hey, there's your NVDA. Oops, that's not going to look good. But we calculate group results again. At the money, naked puts, 3 months out. 4.5% minimum yield or premium received with a 7% to break even, what we might call a downside protection. I apologize if this is a little slow on this history right now. We're loading everything in the background for the end of day. This might actually be, oh, nope, there it is. There's the NVIDIA, because NVIDIA got killed. 3 out of 7 or 43%. Loss of 4.7, where over that same time period, QQQ almost double, not quite, and SPX a little bit more of a decline. But this shows you that once you have an idea of what you want to trade, you can save that search on power options and then use the backtest tools. One of the other things that Sam had mentioned, one of the other advantages of the backtesting tools and power options, of course, is this is the bad one, because I need my debit to strike difference ratio to be less than 1. So for the discussion we had earlier on is this a viable approach to the diagonal spreads, well, I could save this one that we did, which only found the 1 because that net debit to strike difference ratio. But I could save this search in my active search. Then I could go to backtest for the calendar calls, start back in time with the history. By the way, the full history goes back to April of 2006, I believe. So we have over 12 years of end-of-day options data for all strategies and everything along those lines that you can interact with. Now, that being said, if you're doing something that's 1 week out in time to 2 weeks out in time, you wouldn't want to start running that historical search till probably around 2014, 2013, when weeklies were actually taking off. And if you're doing the Monday, Wednesday, Friday thing and you're looking for diagonals that expire in 2 to 3 days, you can't start that until last year because that's when they were first implemented, okay, or towards the summer then. So, but that's the advantage. We could save this search that we created just against SPY, and then I could run the back test against that to see how it would have performed from September in to October in, and then use the historical option chain to say, well, if I had to roll this after the first 7 days, what would I have rolled to? And then what would I have rolled to, and how would that have done? You can analyze that manually using that tool also. All right, well, ladies and gentlemen, I don't see any other questions coming in or have come in that we have not addressed at this time. Oops, sorry, folks. I just want to remind everyone, of course, as I mentioned earlier, I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any of the stocks or options discussed today should not be taken as direct trading suggestions. I'm not saying I'm going to go out and open an SPY diagonal tomorrow or on Monday. If I did, it would have a similar structure to what we showed today, not the horizontal, because that's personal preference. We saw what the horizontal would look like and how that could be a good trade if X and Y occurs and it doesn't go beyond Z boundaries. But I'm not making direct recommendations. Options do involve risk and may not be suitable for all invested. Remember, sorry, that's an error. Markets are going to be closed, copying and pasting. Naturally, markets are going to be closed on Thursday due to the holiday, and then the following Friday, very important, Friday the 23rd, the markets close early, right? So if you need to close, roll, or adjust positions that expire Friday, you got to do it by about, I believe it's 1 o'clock Eastern time. You should probably give yourself some time. Do it by 12 noon Eastern time to roll or adjust those positions before the expiration kicks in. 'Cause it's not open till 4. Right? It closes early. Okay, so just keep that in mind for next week. All that being said, of course, we saw some of the power of the search tools today for diagonals. We looked at how you can use our tools to evaluate, research, and analyze implied volatility ranges, and historical implied volatility of an existing option through that chart on the research page. We talked about criteria you can use for your diagonal and horizontal spreads. We talked about creating a specific search for naked puts based on Paul's criteria. That same type of flexibility is available in all 23 strategies that we support. You want to test out these strategies, you want to test out that search tool to find your trades and maybe test a little bit of the history going back 3 months, even on the trial. Just go to PowerOp.com, put in your name and email address, and you'll have access to the tools for 14 days. No credit card or billing information required. After that, our subscriptions, of course, do start at $40 per month. That's just for end-of-day data, only updated at the close of business. We do, of course, offer a 20-minute delayed service. You can upgrade to the historical service. That gives you access to the full backtesting capability with a 20-minute delay. That's only $100 per month. We do offer real-time and everything, real-time plus the historical backtesting and the API, a programmer's interface. If you wanted to program code to interact with our data, that's $160 per month. If you want some other education, remember you can check us out on our blog, blog.powerup.com at any time. You can also check out our webinar page that I sent you the link to earlier, powerup.com/webinars.asp, where we discuss multiple option strategies, management techniques, options concepts, and of course using the Power Options tools. Everything from the search to just the option chain to the portfolio tools, which we didn't even get a chance to review today. Of course, you can always check us out on YouTube as well. If you think of any other questions about material discussed today, anything else that maybe rang a bell, even though we discussed naked puts and we discussed calendar spreads, but you have a thought of, I wonder if their search tools could do what I want for long calls, bull call debits, or other strategies, just send me an email at any time. support@powerup.com, support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And if you're on that trial, or if you're a current subscriber, remember you can schedule a coaching session at any time. It's essentially a 35 to 45-minute phone conversation. Ernie and I will walk you through the tools on the site, answer any questions that you have. It is not a sales call. I handle the coaching sessions exactly how I handle the webinar presentations on Friday. When you send a question, I give an answer. I just show you what's possible with the tools, what you can do with the tools, and how to use them to match your needs. And I think that sells itself. I don't need to give you a sales pitch. But that's what the coaching session is. You're talking with either myself or with Ernie. You're not talking with a sales team. You're talking with us directly about your questions on power options, option strategies, and more. Ladies and gentlemen, thank you again for joining me. Have a fantastic weekend. If I don't hear from you or see you online before next Thursday, have a happy Thanksgiving. We'll see you back here on Friday in a couple of weeks. There is no open discussion next week on the 23rd, so I'll see you all back on the 30th, but there will be many other webinar opportunities between now and then as well. Take care, everyone. Good night.